The content provided on this channel is for educational and informational purposes only and should not be considered as professional, financial or accounting advice. इस चैनल पर फराहम करदा मवाद सिर्फ तालीमी और मालूमाती मकासद के लिए है और इससे पेशावराना मालियाती या अकाउंटिंग मशवरे के तौर पर नहीं समझा जाना चाहिए। Liquidity. Asset. To be liquid, it needs to meet two conditions. Condition 1. Ease with which asset is converted into cash. More ease, greater liquidity. Less ease, low liquidity. Condition 2. Without significant change in the market value of asset. Insignificant change, greater liquidity. Significant change, low liquidity. Feature of liquidity. Speed of conversion. How fast an asset can be turned into cash. Minimal loss in value. Conversion should not lead to a significant loss in the asset value. Liquidity is directly proportional to speed of conversion of asset into cash. Speed of conversion is high. The asset is highly liquid. If the speed of conversion is low, the asset will be less liquid. Liquidity of asset is inversely proportional to the loss in value of the asset. If the loss in value of the asset is insignificant, means there is a minor change in the value of asset, then the asset will be highly liquid. The loss in value of the asset is significant, then the asset will be less liquid. Types of liquidity. There are two types of liquidity: market liquidity and accounting liquidity. Market liquidity is related to the market, and accounting liquidity is related to the company. Refers to the ability to buy or sell assets like stocks or bonds in the market quickly at stable prices. High market liquidity means there are many buyers and sellers, so transactions happens quickly. Accounting liquidity. Accounting liquidity refers to the company's ability to meet in short-term financial obligations like paying bill using its current assets, measured by ratios such as quick ratios, quick ratios, asset test ratio, and cash ratio. Examples of liquid and illiquid assets. Liquid assets. Cash, bank accounts, publicly traded stock, and cash equivalents are the liquid assets. Illiquid assets. Real estate, rare collectibles, machinery and equipment. Non-current assets are typically illiquid assets. Common liquidity ratios. Current ratio, quick ratio, or asset test and cash ratio. Current ratio is calculated by the formula current asset divided by current liability. Quick ratio is calculated by current asset minus inventory divided by current liability, and cash ratio is calculated by cash plus cash equivalents divided by current liability. Current ratio measures the ability to pay short-term obligations with current assets. Quick ratio excludes inventory for a more stringent measure of liquidity, and cash ratio focuses only on the most liquid assets. Importance of liquidity for business. Number 1 indicates the ability to meet operational expenses and debt obligations. Number 2, low liquidity can signal potential financial difficulties of a business.